Okay, hello everyone. How are you doing? My name is John O'Donnell. Thank you for coming to our webinar today. I'm the Chief Knowledge Officer of Online Trading Academy. How many of you have heard of Online Trading Academy? I would hope many of you have seen the Online Trading Academy presentations by Sam Seiden and other instructors, and I've given several here myself, so welcome back. I also am the co-host of PowerTradingRadio.com, and I can be contacted at john@tradingacademy.com, and I have a whole series of webinars available for you that will complement the content you're going to see today. So just email me at the end of this, and I'll be happy to send them to you. The title of my talk today is 2011 Market Forecasts. I could have titled it Perception versus Reality in the Transition to the New Normal Markets. Now, I didn't invent this term, new normal. It was pretty much made famous about a year ago by PIMCO, Bill Gross, one of the largest bond management firms in the world. But my spin on this is that the transition to the new normal is going to be different than many other periods because it's going to be led by what I call the Globalization 3.0 deleveraging credit purge cycle, and this deleveraging is going to take place in primarily the private sector, not the public sector. And that is uniquely different than other credit purge environments that we've experienced throughout the world. Now, my presentation today is not going to be this kind of economic presentation at all. Although many of you probably studied economics at university, I'm not a Keynesian. Quite frankly, I'm a follower of the Austrian School of Economics. And as far as I'm concerned, they totally discredited Keynesian economics. But let's get into this a little bit and talk about what's going on, first of all, in the economy, because we see some anomalies that compared to previous recessions going all the way back to 1945, the world today, at least from the U.S. perspective, and the U.S. perspective is important because we're the largest global economy in the world. Although we're only 5% of the world's population, we consume over 24% of the world's GDP. And so the producers across the world depend upon the consumption pattern of the American consumer. And this deleveraging of the balance sheet of the American consumer, some of which is going on voluntary, some of which is involuntary, is going to have a big impact on the slowing of the global economy. And, of course, this is going to have a big impact on currencies as well. So let's take a look at this. First of all, let's take a GDP. What I'm comparing here in the red, yellow, black, and blue charts are multiple economic barometers that are relatively current, comparing quarterly economic output. On average, the yellow line on average of each chart is where we are since the average change since 1946. And the black line is current where we are today. And so let's go through this. If you look at the average economic quarterly growth since 1946, it's about a growth rate of about 10.1%. Economists tell us that we ended our recession in America in the summer of 2009. I personally don't believe we really ever left it. But our current GDP growth is 1/2 the average rate of growth. Now, what's leading a lot of this are home price declines. And these are, again, best case, average, current case, going all the way back to 1946. And these are quarterly adjusted home prices, adjusted for inflation, are in real terms. And let's take a look at the average. The average is about 0.6%. We're at a negative 10%. Now, considering that home prices account for over 40% of the weighting of the consumer price index, you can see why we are told we virtually don't have much inflation at all. Let's take a look at total manufacturing jobs. Notice that the average coming out of a recession is a job growth rate of about 3.8% per annum. And notice that our current job growth rate is about 1/10 the average at 0.3%. Total jobs on average, that's non-farm payroll jobs, grow at a rate of about 5%, 5.3% coming out of a recession. And again, we're at about 0.40%, which tells me again we're at about 1/10 the growth rate. And I don't believe we can have a bottom in the housing market until we in America start creating jobs. And of course, jobs are the bedrock, the mother's milk of consumption. And when you consider in a $14.5 trillion economy that we have, that consumption in America makes up over 70% of GDP, and if we are the engine to the world to consume the goods and services they produce, you can see why this is a drag on the world economy. Let's talk about disposable income. Obviously, disposable income is very important because it allows us to buy durable goods and other items that are important to us. Historic growth rate is somewhere in the vicinity of about 8.8% in yellow, and today we are at 1.8%, or about a quarter of the growth rate. So, if in fact we did come out of a recession, and I'm convinced that there's an argument to be made we didn't come out of a recession in summer of 2009. Matter of fact, I kind of think we're back in it, so we don't have to have a big debate as to whether we're going to have a double dip. My position is we're still in the recession. I think the economists misspoke on calling an end to the recession in the summer of 2009. Of course, hindsight's always 20/20, but as far as I'm concerned, this is what this data is telling us and confirming. The average growth rate of personal spending coming out of a recession is about an 8.5% growth rate. You can see today that our personal spending is growing at a rate of about 4%, 1/2 the average. Let's talk about exports. We've got looking better on exports. The average growth rate in exports is about 3.7%. But we seem to be growing today at 20.6% our exports. And I think the primary contributor to that is a cheap dollar. Cheap dollars across the world make the goods and services that we produce, for those companies that have anything to export, makes their products more attractive. But here's a very woeful anemic sign that is part of the credit purge story that we're going to cover today, and that is bank lending. The average bank lending profile grows coming out of a recession, again since 1946, at about 19.7%. Our bank lending today, look at this, is a woeful negative 4.1%. So if bankers have changed their appetite to lend, and borrowers have changed their appetite to borrow and consume, what logically do you think is going to happen to the velocity of money through our economy? Well, it's going to slow. I mean, I don't think you have to be a rocket scientist to figure that out. And that's the condition that we're in today. But yet, all of this data I've showed you seems to be conflicting with what we're seeing in corporate profits. Take a look at corporate profit profile. The average growth rate in corporate profits adjusted for inflation in real terms in yellow is 37.4%. Our profit growth rate has been a startling 46.6%. Now, how do you account for this? Given all the negative data we've showed you in the previous charts, why are corporate profits up? Well, certainly a cheap dollar has something to do with it. Remember that 40% of the earnings of the S&P are related to import-export business. So if exports are up of goods and services, as demonstrated in this chart on the left, it's going to have a big impact on corporate profits. But the real big impact on corporate profits, on why we've seen corporate profits do so well, is because businesses have been right-sizing their business model. They've been shutting down product lines, laying off workers, right-sizing their factory and widget capability to produce. And basically what we're seeing is a tremendous growth in efficiency. And isn't that the role of what a business is to do? Is to raise productivity, or worker output per worker, and produce more with less workers. That's pretty much the role of business. Now, if you've ever owned a business, you know that's what it's primarily about, is to raise revenue per employee and raise earnings per employee. And of course, let's not forget automation. Many automation tools have been put in place by corporate America. And again, they're running lean and mean in an environment that we just described. And I think that accounts for growth and profits. That being said, how much more cutting can you do? How much more can you raise your productivity? I think the jury's out on that particular question. Now, this is the change in the price-to-earnings ratio. Larry Kudlow likes to say that earnings are the mother's milk of capitalism. I like to say that the credit market is the mother's milk of capitalism. And there are two components of a credit market. One, a willing lender, and secondly, a willing borrower. Unless there's a handshake between a willing lender and a willing borrower, it's very difficult to capitalize a business in today's world and to facilitate trade. So the credit market, I believe, i.e. the bond market, is the most important market in the world. Remember, there's really only two forms of capital. There are credit instruments called bonds, and there's equity instruments. And in the corporate hierarchy, if a company gets in trouble, bondholders need to get paid first. That's why the most risky, volatile price component in the world today in corporate finance is the equity market. Now, let's take a look at that price volatility or valuation extremes. This is the constant dollar price of the S&P 500 as measured by the Graham-Dodd price-to-earnings ratio, going from, in this particular example, 0 to 60. And you can see since 1881, we've seen all kinds of volatility, all kinds of innovation cycles, all kinds of geopolitical events that have led us to what I call today the Globalization 3.0 era. Now, I believe Globalization 1.0 goes back to World War I. Globalization 2.0 goes back to World War II. And we are now in what I call the Globalization 3.0 era of transition to the new normal. And let's talk about what that might look like. This is an interesting cartoon I picked out the other day. For those of you that are familiar with Sam Seiden, our VP of Education and his supply and demand webinars at FX Street, you might find a little humor in this particular cartoon. The guy here on the left says, I just got a stock here that could really excel. Really excel? Excel? Sell, 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 sell. And this goes on, and the madness goes on, and this guy here says, I just really can't take this madness anymore. Goodbye, I'm out of here. Goodbye, bye, 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 bye. And I really think that's part and parcel that really what drives these extremes in valuation from periods of overbought to periods of oversold valuation extremes. And I think there's one message here in this chart, in this macro picture, is that price extremes of either overbought or oversold are never sustainable, regardless of who's president, regardless of the geopolitical condition, or regardless of who's in power at the Fed. Now let's talk about global GDP. If we're truly in the Globalization 3.0 era and transition to the new normal, we need to talk about well, what the old normal and what the new normal kind of looks like. So if you look at present global purchasing GDP adjusted for purchasing power parity back to 2008 valuations, you see that the U.S. is roughly 21%. The development of Europe is around 21%. Japan is about 6%, and the other developed countries are about 3%. So if we take one half of this pie, let's say that U.S., Europe, and Japan are about 50% of global GDP. The emerging markets account for about 26% of GDP. Brazil is 3, Russia's 3, India is 5, and China's 12. Now, we know that India and China pretty much have some of the fastest growing economies in the world, and you can see over time how this pie is going to adjust as the left side of this pie grows at a much faster rate and captures more market share as a percent of global GDP. So what I think we can expect in the new normal is slowing, stagnant growth in the developed world and accelerated growth in the emerging world. But remember, the products and services that the emerging, as the standard of living of the emerging world grows, as they produce goods and services and sell them to consumers here in the developed world, you're going to see a tremendous shift of wealth from the developed world to the emerging world. Now, what's driving all of this transition to the new normal, and I believe it is truly a paradigm shift that we're only going to see once in our lifetime, is what we call credit purge of balance sheets in the private sector. That is the removal of debt voluntarily and involuntarily off the balance sheets of the private sector, and of course an expanded balance sheet in the public sector at all levels of government in the developed world. And of course, what's also having big impact on this, because of fear and uncertainty, is fundamental demand destruction that's accelerating in the developed world among consumers. So here's what's driving what I believe and will accelerate to continue probably through the rest of this decade, a terrible recession. Slow, stagnant, John Malden likes to call it the muddle-through economy. I think in some cases that's being very generous. There are certain sectors that are going through credit purge at an accelerated rate. There are other sectors that have robust capital formation taking place, but it's very uneven, and it's going to create, I believe, a lot of volatility and a lot of trading opportunities for those that are prepared, that have the right tools, that are knowledgeable, and that are in the right support system. I think there are going to be some wonderful profits made in this period that we're forecasting. This, in essence, is the crux of what I see as the economic crisis for America. There is an implosion of global trade taking place. Global trade is slowing at a precipitous decline. There is an implosion of household balance sheets taking place. In the area of global trade, do not forget, in a $14 trillion economy, global trade for America alone is about 10% of GDP, which is about $1.4 trillion. And we're not creating a lot of new jobs in that area right now. Secondly, the real big rock that's a real weight to carry for the global economy is the deleveraging of the American family's balance sheet. And, of course, we've seen the primary cause of that deleveraging has been the loss of jobs, regular sources of income, and secondly, the decline in home equity. It's estimated that 1 out of 4 homes in America today have negative equity. And I'm not convinced we saw that during the Great Credit Purge of the 1930s. There's thirdly, the other big rock that we're dealing with, and you can see this at Citibank, Bank of America, and various other major multinational Tier 1 banks in America, is an implosion of the balance sheet of the banks. The banks still have many rotting deteriorating, non-performing assets on their balance sheet. I don't believe they've really come clean on their accounting, and we're going to continue to fight that battle through the rest of this decade. But let's take a look at debt. If the Achilles heel of the developed world is debt, we have to look at the debt to GDP ratio to really understand the condition that we're in. And to do that, we have to look at the historical ratio. And this data I get from the Federal Reserve System. This chart asks a very important question going all the way back to 1870. The gray bars in the background of this chart are periods where we had recessions. This chart is asking how much debt as a percent of GDP debt does it take to create $1 worth of GDP. So this is total debt. This is both in the public and private sector of our economy. But take a look at this pattern. From 1870 through roughly 1920, debt as a percent of GDP was between 140 and 160% of GDP. The debt binge of the 1920s brought about by this era led to, under Austrian economic theory, the credit purge of the 1930s. This is World War II, and it's relatively a small bump in magnitude of what took place in the 1920s, which was the unprecedented appetite for risk to take on debt and lever up the balance sheet. But take a look after World War II, from the 1950s through the 1980s, or the 1940s through the 1980s. This is 4 to 5 decades of time in here. Debt as a percent of GDP went back to where it was in the 1870s, at about 140, 150% of GDP. And who's the reluctant here? Ronald Reagan. Now, what does Reagan bring to the party to create all of this? Well, he brings a lot of confidence. Confidence for what? Remember, we elected Reagan after coming off the dismal period of Jimmy Carter as president. And what Reagan brought to the party that created this massive amount of debt accelerating at a tremendously more advanced level than growth of GDP was confidence. Confidence for what to happen? Confidence for lenders to lend, confidence for borrowers to borrow and consume. And that's where we are today, and debt as a percent of GDP today is over 350% of GDP. I want you to note that we are turning the corner here. And ladies and gentlemen, this is the new normal. This is the new normal, and we're starting to see the evidence of the deleveraging of the balance sheet. Now, I'm not necessarily forecasting that it's going to delever at the rate that it did of the 1930s, but we have certainly turned the corner, and we are in the credit purge era now. How, of course, has this impacted the stock markets? Well, one of the best leading indicators of the stock market, where we have good data going back to 1900, is the Dow Jones Industrial Average. What I'm showing you is the Dow Jones Industrial Average since 1900, adjusted for inflation. Now remember, from 1900 through 1971, we were on a gold standard. Yesterday, August 15th, 1971, was the day that Richard Nixon took America off the gold standard and made our currency non-convertible. So let's take a look at this. I want you to note that when adjusted for inflation, the Dow 1982 low right here reached a lower level than the Dow price in January of 1900 right here. That's a phenomenal factoid that a lot of people have never looked at. They've never taken into consideration a Dow adjusted for inflation of over 82 years being relatively flat. Now, I want you to note in the blue area here and here that adjusted for inflation, we had long periods of negative returns in the Dow Jones Industrial Average for both periods of time. Now, This is the market that I'm forecasting going forward, and we'll take a harder look at it in just a moment. This is the Dow Jones Industrial Average from 1967 through 1982. Very volatile, extremes, periods of overbought and oversold conditions. And again, going back to our pattern of the past, periods of overbought never stay sustainable, and periods of oversold conditions never stay sustainable either. And quite frankly, at Online Trading Academy, that's why we're traders, and that's why we have totally abandoned the buy and hold bias. Now, this is a little closer picture of that same period of time, approximately from 1970 through 1978. Let's take a look at this today. This is the 1970s Dow, and I've laid over below it the current Dow today, relatively current through mid-July. And I think you can see a remarkable similarity. Of course, we've seen, I haven't put in the red candles for the downtick we've recently seen. And I think today the Dow's trading at around 11,300, so we're continue seeing some red candles. This is that same 1968 through 1978 era, periods of running to overbought conditions, leading to oversold conditions, again, neither of them being sustainable. And this is the pattern of the Dow from 1998 through now. So as far as I'm concerned, it's kind of back to the future. We're seeing these markets play out remarkably similar patterns of fear and greed. Now, I want to show you an institutional index many of you have probably never seen before. Have any of you know what the institutional index is? I happen to have labeled the institute. Type in chat if you know what the institutional index is. What is it? Because I believe the institutional index is giving us a very clear message that we're in a secular bear market, and that we've been in a secular bear market that really started in first quarter of 2000, and that we're still in it. And I believe the institutional index is the most important equity index in the world. It's more important than Dow, the S&P, the DAX, the FTSE, Nikkei index, any index you want to take. It is the most important equity index in the world. I don't see anybody typing in the chat. Let me tell you what the institutional index is and why it's so important. It's an index that's in a secular bear market, by the way. It represents over 78% of the equities that are in the portfolio of financial institutions in America. So I think it's a critically important measurement, and it looks nothing like the Dow or the S&P over the last 10 and a half years. Do the comparison for yourself. And I think it's sending us a very bold message that we are still in a secular bear market, and that the cyclical rallies that we have been experiencing have high probability of price failure. The flight to safety trade, of course, has been reflected in gold. Let's talk a little bit about gold. First of all, I've been engaged with gold since 1971. I used to own a gold and silver reclamation business through the 70s. I sold it out in 1981, and I'm glad that I did, because we then went into a 20-year bear market from 1980 through 2000. But I've always had a very warm spot in my heart for the gold versus fiat money story. I cut my teeth on Professor Murray Rothbard's book, What Has Government Done to Our Money? And as a kid, I was a coin collector. So I've always had a good understanding of the history and the evolution of change of money. Let's first of all look at what is money. I think the concept of money is grossly misunderstood by the general public today because they know nothing of the real history of money. And when you take the time to study the history and evolution of money, it's really a fascinating study. Money is designed to be an important part of society in that it is a medium of exchange. But the second characteristic of money, a lot of people seem to have forgotten, and that is it's required to be a store of value. And the U.S. dollar and other fiat currencies have been good mediums of exchange for many, many decades, certainly since World War II. But they haven't been a very good store of value, if you really look at the data, compared to gold. Even with a 20-year bear market, let's take a look at some of this data. This is the gold price in the Consumer Price Index adjusted for inflation. And this is the dollar index, CPI adjusted in black. And you can see a very stark contrast as the dollar starts to deteriorate in purchasing power. We see that the real purchasing power of gold, even in inflation-adjusted dollars, is performing extremely well. Yes, Jack, the Fed did say that gold is not money, and I think Mr. Bernanke needs to go back and study the fact that gold has been real money for over 3,000 years. And I think Ron Paul asked Bernanke the right question. Mr. Bernanke, in your opinion, if gold is not money, then why do central banks across the world hoard it? Of course it's money. It's a flight to safety money and has been money since it was invented in ancient Lydia over 3,000 years ago. And I happen to believe we will eventually one day will be so much financial uncertainty and that fiat currencies will probably fail as a system of monetary exchange. Markets will force the world to go back onto some kind of a gold convertibility standard. Now let me tell you something I've done, and I've done this Dow Gold ratio for over 40 years that I've been engaged in the markets. And I recommend you do the same every Friday. What I suggest you do is take the nominal Dow and divide it by the nominal price of gold, and you put the next tick on this chart. And you create a simple price ratio. What is the nominal price of gold relative to the nominal price of the Dow? Now, I could use anything as my denominator. I'm using, in this particular example, going all the way back to 1800 to show me when stock prices are high relative to gold and when stock prices are low relative to gold. And if you look at this green channel, it's very clear for over, this goes back to 1800, for over 200 years, what the Dow Gold ratio has given us some signals as to when the Dow is cheap relative to gold and when it is expensive relative to gold. Now, why am I using gold as my denominator? I could use anything as my denominator. I could create a price ratio of virtually anything. I could use the CRB index. I could use oil. I could use the Swiss francs. I could use the British pound or the euro. I could use the price of wheat, the price of corn, soybeans, copper. You can use anything to create a price ratio. Why do I use gold? I use gold because gold is real money. And it's a form of real money that no central bank can print. And that's why they hoard it in times of financial crises. Now, let me show you a very interesting chart and make a parallel between the Dow Gold ratio here at the top and the Dow Cash ratio here at the bottom, going back to 1982. So I'm going to go back all the way here to 1982 and take a look at this period of time from 1982 to where we are today. I want you to note from 1982, and remember, we had a bear market in gold starting in 1980. Gold was $850 in 1980, and in 2000, which is the blue line here, gold was trading at $250 an ounce. But we also had a rip-roaring bull market in equities relative to gold. And you can see that in this chart right here. This is what real bull markets look like. Well, let's take a look. If it's a real bull market, the Dow should be going up relative to cash. And that's exactly what we saw from 1982 through 2000. And here's my point. In history, I have found, in going back, is that the Dow cash ratio has a tendency to follow the Dow gold ratio. Now, remember, in 1982, Nixon took us off the gold standard in 1971. So this was the price of the Dow in fiat money, and this was the price of the Dow in real money. But look what happened. We see the Dow gold ratio go roughly from 1 to 1. In 1980, gold was priced at $850, and the Dow was priced at $850. Right here, we have over a 40 to 1 ratio of the Dow gold ratio, where it peaked out at roughly 40 to 1. That was 11,700 on the Dow, and that was 250 on gold. Now let's take a look at what's happened since. Since then, we've had this rip-roaring bull market in gold going from 250 to 1,700 and change today, and we've seen the Dow gold ratio decline from a 44 to 1 ratio to about a 6 to 1 ratio today. Remember, this chart's only going through the early part of 2010, so this chart is not quite complete. And here's what we've seen in the nominal Dow. And under our theory is the nominal Dow will continue to follow the pattern of the real Dow. And that's exactly what I think we're seeing now. And of course, we've got the nominal Dow back up to about 11,000, right about here. And what this is forecasting to me is this is going to go back, and we're going to go back and retest the old lows. Now, let's think about this for a moment. Let's assume that we've seen, there's been 2 times in history when we've had roughly a 1 to 1 Dow gold ratio. One was the bottom of the 1932, right in here, the bottom of the 1932 Great Credit Purge, and the other was 1980, right about here. Those are 1 to 1 ratios. Let's assume we go back to a 2 to 1 ratio, not a 1 to 1 ratio. Let's assume the Dow comes down to about, let's assume it comes down to about 8,000. Okay? Let's assume it comes from 11,400 down to about 8,000. It's been, in 2009, down to 6,700, I believe it was. Now, if the Dow gold ratio comes down to a 2 to 1 ratio, and if the Dow is at 7,000, I would take 7,000 and divide it by 2, and that would give me a target for $3,500 gold. Now, I know that price seems extreme to you, but let's take a look at what it could look like. This is a closer look at that Dow gold ratio going from roughly 44 to 1 down to about 6 to 1 today. Now, why do I believe that this is a reasonable price target? Well, let me show you why. Back in 1980, when there was a 1 to 1 Dow gold ratio, gold at $850 today had certain purchasing power parity to a basket of goods and services. For gold today to have the equivalent purchasing power of 1980 gold, it needs to be trading today at $2,300 an ounce. So I don't think gold is overpriced at all at $1,700 an ounce. Let's take one other metric that I find very important, and although I don't have a chart on it to show you today, I have done the research going back to 1929, and if you want to email me, john@tradingacademy.com, I'll be happy to send you the charts and the webinars that explain this. If you take and ask a simple question, how many units of gold does it take to buy 1 unit of the S&P, you will discover There are periods of time where it's been a 0.5 to 1 ratio to as high as a 7 to 1 ratio. But the average, and remember, markets are mean reversion animals, the average gold S&P ratio has been 1.5 to 1. So if you take roughly 1,200 S&P today, multiply it by 1.5, you get $1,900 gold. And that's why I'm still bullish on gold, and I think you're going to continue to see it trade eventually over the next year at over $2,000 an ounce. Now, let's take a look and price gold. Let's talk about opportunities in the hard currency versus soft currency play. Obviously, if you're in Europe, you've seen that this is the euro Swiss franc trade, and this is the Swiss franc euro dollar trade. And I think the Swiss franc, but let's take a look at pricing gold in dollars, which is in red, but let's take and price gold in Swiss francs, which is a very hard currency. Although the Swiss franc is not backed by gold, the Swiss franc, the Swiss government, constantly mind their own business. They don't fight wars. They don't run big deficits. They're considerably disciplined fiscally and in their politics. And I think it's reflected in the value of their currency. Take a look at this. You've seen this tremendous loss of purchasing power of the U.S. dollar relative to gold in red, and that's best shown in this chart right here. But take a look at gold priced in Swiss francs. It's been relatively flat this whole year, when in fact the U.S. dollar has not run very well, nor has the euro. And I could show you the euro and the British pound looking remarkably similar. But the two flight to safety trades pretty much have been short-term treasuries, gold, and of course the Swiss franc. Now, another way to look at gold, using it as your denominator, is the Dow Single Family Home Index. And this chart is asking a very important question again. How many units of gold does it take to buy the average single-family home? Now, you can do this for your neighborhood. You can do this for the country you live in. You can do this for the neighborhood you live in by getting some price data charts on the price fluctuation of the average single-family home in your neighborhood. And you can get a price chart on gold, and you can draw a chart up like this very easily. And you can see that, of course, gold as your denominator, again, as a form of money, has done very well. Solomon has a question here. Someone told me that price of gold doesn't change. What changes is other products' values. That's correct. I believe that's exactly right, and I think these charts are showing the same thing. If you look at gold as a constant and ask the question, how many barrels of oil, how many bushels of wheat, how many tons of copper does it take to buy an ounce of gold? If you do the math, it's pretty simple. If you use a flat line for gold, you'll see that everything in the world, including wages, could be measured in grams of gold, fluctuate relative to gold as your denominator. And I think that's a great way to look at it. And Murray Rothbard, if you want a book on this, and I've got a webinar that outlines this very well, just send me an email, and I'll be happy to send them to you. Let's talk about gold relative to equities. We've already kind of looked at this, but how many shares of the Dow Jones Industrial Average, or how many units of the Dow Jones Industrial Average does it take to buy a new U.S. home? So if we've seen how gold has performed relative to the U.S. home, we can see how well the average home is compared to the average U.S. stocks. For those of you that are not familiar with the work of Online Trading Academy, I encourage you to go to FX Street look up Online Trading Academy. You'll see a whole bunch of webinars there by Sam Seiden on how we use supply and demand. Sam's our VP of Education. Yes, my email address, I'll type it in here, is John at, you can reach me at otahq.com, and, oh, what happened here? I don't know what happened. But at any rate, I'll be happy to send all that to you. But if you go to FX Street, how are we doing? Can you see the slides? Okay. Can you see the slides all right? I guess so. We have a lot of webinars produced that are archived at the FX Street site under Online Trading Academy. We do a lot of work using supply and demand zones, where we find and do trade setups that work remarkably well in various time frames. And we have served the FX Street community for years. Matter of fact, I think Sam, our VP of Education, won 3 awards at FX Street. And I encourage you to go back to FX Street, do a search under Sam Seiden or under Online Trading Academy, and view that great work. And you'll find several of my webinars there as well. Our performance has done extremely well in our room, our Pro Pick room. This is our month-to-date performance, and I think you'll find this quite beneficial. So check us out. We're OnlineTradingAcademy.com. We have 35 centers across the world to serve you, and I hope to see you in the room soon. Thanks a lot.